Simeon Papailias, thanks for joining me, man.
My pleasure to be here, Patrick. Nice to see you again, my friend.
How do you see what's going on into 2023?
Yeah, so I don't need the Globe and Mail or any media outlet to tell me if I'm in a recession or not. I know we've been in a recession since June, when consumer sentiment, consumer behavior, physical evidence of inaffordability and constraint are happening all around me. I know I'm in a recession. So if I can't walk 2 steps without somebody almost crying about what's happening to them and what happened to their restaurant margin, e.g. my brother, who owns 2 restaurants in central Alberta, is literally working on a 3% margin or at a loss because you can't sell 2 pizzas for more than $40.
Yeah.
And this is like specialty mom and pop shop where the whole city knows him with lineups. So this is a great product, not cheap fake cheese, real salami, not fake salami. For him to give that product out, he's making either nothing or a margin that's too thin to care for. So we don't need to label, are we in a recession? And this now goes into everything. So economy right now is a big topic. In real estate, it's being felt in a way like none other. Again, I'm going to put myself a little bit outside of that because we're very blessed to have very strong networks and business development strategies. But so we're okay. But the average real estate agent, half the inventory, it's 49% down as of December 1.
Yeah.
So half the transactions.
I've talked to a number of realtors who are, let's say, as realtors, they would do, let's say, 5 to 10 deals a month. And they're like 1 and none. And it's like somebody turned off the tap. So in the space of realtors, and I'm sure for mortgage brokers, although I do know some mortgage brokers who are quite busy, but when I look overall, what we're seeing is that industry has just really started to get quiet and quieter. To your point, no listings, no inventory, hard to sell something that isn't there. And, sellers aren't coming off so much on their prices. Although, let's talk about this a little bit. So I align with you in terms of recession feeling. We're not in a technical recession by the numbers in terms of GDP. So that's one side of it. Sales
and that's huge, by the way.
Yeah.
So the fact that we have a way bigger than expected GDP and employment growth instead of loss is probably, this is if there is going to be a actual recession, it's the funniest recession the world has ever seen.
I don't see us going into a technical recession in 2023, not at least the first half, for sure not the first quarter, but you never know. But what I'm looking at is, because I look at these numbers a lot, Simeon. So when I'm looking at GDP, when I kind of lift the hood on what GDP is made up of, it's really interesting to note that our GDP for this third quarter, which we just got the numbers on really, was based on some exports that we did because of oil. But when we look at consumer goods of consumer buying, and when we look at other aspects, manufacturing, for example, guess what? There is no growth there. It's actually declined. So what makes up our GDP is definitely weakening. The good news is that we've still got good jobs. And that's an interesting problem that we face because we don't have enough people to fulfill in those jobs. Different story. I want to tell you a little bit about real estate because we see prices coming down. But when I'm looking at my research, and you tell me, so I'm looking at all the headlines and blaring headlines. I mean, it's like clickbait, isn't it? It's just driving me crazy. Down 28%, prices 32%, Vancouver, Toronto, all these numbers are being thrown on the table. But when I'm looking at the charts, it's like compared to the anomaly in the second quarter, let's say, of 2022. When we look back to 2019, 2018, we're still up in a lot of those areas. What's your comments on that, Simeon?
Well, it's exactly that. So they're taking the outlier and trying to pretend that it's the benchmark.
Yeah.
The outlier is the outlier. The benchmark is the benchmark. Even if you were to take the conversation to October of 2021, use October 2021 because it's the 4 months that led to February that created that anomaly, that created the outlier.
Yeah.
And the reason February became an outlier is because our government announced, which they should never announce, and they knew they should have never announced, that we got Canada's back. Interest rates aren't going anywhere anytime soon. That was the comment.
Yeah,
So
2023. 2023 at the earliest, quote unquote, Mr. Tiff Macklem,
quote unquote. So you tell people to literally go buy, you're safe, do what you need to do, everything's going to be okay, and then slap the glasses right off their heads as they're signing their papers at the bank, creating this stress and this shock and awe campaign that led to newspapers selling record digital subscriptions.
This incompetence of our government and our Bank of Canada, I've made it public statement. I've put it out there publicly, in my opinion, for what it's worth, and that is Tiff Macklem should have been fired a long time ago. But certainly he should have been fired in the past few months. He's admittedly made mistakes. There's consequences for millions of people across the country, yet there are no consequences for him and his team. And that really gets me riled up and fired up, but we're not going down that place. At the end of the day,
and just to say, because we'll call them whether mistakes, it's reckless and irresponsible. It is what it is, because you are my guiding light, Bank of Canada CEO. When you speak, I listen. Because I have to. Like, this is how I guide people. And you tell me to go north when really you're going south.
Anyways, it is. You and I are totally aligned on that one, Simeon. Okay. In spite of all that, when we look at what's going on globally, we start to understand,
Sorry, I wanted to finish that comment, because so what does that mean with pricing? 2019, 2020, 2021 saw growth in this country that nobody earned or deserved. It was also created by unreasonable actions like 0% interest rates. So all that gain we made, and I'm speaking we as in, let's call it 50% of the country acted on real estate during that time. Anybody who bought before, which is the other 30%, gained as well. So for the 5%, 2%, 1%, whatever the real number is, that bought in that 6-month period, whatever pain you may be going through, I'm sorry, but you are a fringe. And you do not bring down a country's economy because you bought there. It's unfortunate you were misled. It's unfortunate your timing wasn't right. It happens. And it sounds maybe a little bit tough, but there's nothing anybody can do to help you.
100%.
So it's just that period. But looking at it overall, that 10 or 15 or 20% down on a 60% up market, we're all okay.
We're going to be, yes, I agree. And it will get uncomfortable for many. And that is, again, unfortunate. We also know that, something that we talk a lot about, Simeon, is that when you're dealing with, let's say, an REC Canada investor focus, they understand the markets of what is going on. They're not pushing speculation. And part of the problem that we see in the industry overall is there was a lot of speculation in this space, and they called themselves investors, but they were not investing on any kind of fundamentals, any understanding of it. They were investing because of FOMO. They're investing because they're somebody in their family said, oh no, you'll get rich, or their neighbor or their peers at work. So it was really chasing money as opposed to putting a clear plan together. And so I want to put that on the table and just say, let's be really cautious about when we use the term investors who got in trouble. It was really speculators primarily. My own belief system, or my own belief, is that it was primarily speculators that got in trouble. Investors who were kind of understanding what it is they were doing were less susceptible to some of the fallout that's been taking place right now.
Yeah. And I mean, when we speak to this specific conversation, I like to really call a spade a spade. It's gamblers that got in trouble. Because speculator is a very, very kind word for gambling. Investing and gambling are two very different things. There's gamblers who are investors, like those genius poker players. That's an investor. He's making an investment in himself to take your money because he knows how. But other than that, there is nothing in investing that has to do with gambling. It's sound research and decisions that are founded on principle that we know is to be true in the realm of leverage in real estate.
It's interesting, and I'll just add on this before we move on, is that, it really is part of a plan. And one of the things that you do, with REC is you align your clients with your broker connections who are also investor focused, who also understand a financial plan in terms of mortgages and how to put that all together so that there is some sense to what's going on and understanding where people are financially, the levels of risk that they're going to be taking on or not taking on. And we have to kind of bring that all together because it's an important part of, again, gambling versus investing, is that it is a holistic plan. So when you're sitting down with somebody like you and your team with REC Canada, you're actually looking at it through a different filter, a different lens. Anyways, I want to shine a light on that because it's so important. And it's why true investors can have success investing in real estate. Now, let's move on.
Yeah.
Move on. Okay, next phase. Next phase of this conversation where I want to take it is understanding the global macro. And I know you pay attention to it. We look at the geopolitical issues. We see what's happening in Russia, China, Ukraine. We've got Europe that's, going, like it's really shutting down in a big way. UK is in trouble. There's so much going on in geopolitical macro kind of point of view. Oil prices, I think, are going to continue to rise. They're down right now. That's not going to last. I'm saying $100 oil. That's only part of this conversation is this. We still, as investors, need to get our capital to work in this particular environment. It's never been more important. Now, you may believe that precious metals, gold and silver is part of that. Perhaps some Bitcoin is part of that. You and I believe also that if aside from that, real estate's an important factor. And regardless of what's going on, there is a way to invest in real estate regardless. So let's talk a little bit about that.
Yeah, so there's multiple strategies to invest through tougher times or anomalies in real estate. When the market is going up 60%, it's not one you want to invest in. It's hold what you got, and if you're so lucky that nothing happens, you're going to be a millionaire. But I don't put money out on real estate when we're going up 15% a quarter, because I know something bad's going to happen at any time. Dumpster fire is around the corner. So it's people think it's a good time. No, it's not. It's the worst time to do it. I'd rather sit it out and say, damn, I wish I did. But when the other shoe drops, you say, thank you, I wasn't there for it. So through a recession, through turbulent times, volatile markets, cyclical things that happen, you have to look at time. Time becomes the biggest factor. So there is always the asset, its replacement value. There's the asset, its future value. There's many different principles that you can build a portfolio around. But in the time like this, you have to be able to look in the mirror and really understand and believe, because it's your money, it's your hard work you're playing with. This is not my plan or Patrick's plan. This is your plan. I can tell you a million things to do, but it has to fit your plan. You can pick and choose from the menu.
Yeah.
So in this case, right now, we know for sure that the next 18 months are not going to be rosy. 12 months might even be bloody.
Yeah.
But 18 months we know are not going to be rosy. 24 months, I would say, listen, I'm just not a negative outlook person. I know we're going to figure a way as Canadians on how to make this economy work, how to wash the sins of our government, all their things, because we've done it before and we'll do it again. So I'm going after so I'm going to take the guiding principle that I'm using right now is a 3-year timeline. I will say with absolute confidence on this recorded call in December of 2022 that I believe real estate values in this country in general are going to be higher maybe catch me on a great afternoon like today, probably double digits, 10% at the very least higher, average countrywide 3 years from now than they are today.
And you've played this game for a long time. So, understanding that real estate goes through cycles, and it's interesting. It is interesting to watch. I mean, I've been on this earth long enough to have been through 5 recessions, and
but you have double my time in the market.
Exactly. Buddy of mine pointed that out to me, and so I laugh about it. But but the thing is that it is so strange that when we recognize the FOMO period that we went through in 2022, and everybody wants to be a real estate genius. Now, when the markets turn, we go from being in that, we're kind of into that slump part of the real estate cycle, out of the boom part into the slump part, which is exactly where the best opportunities will be and are to create. And people go, whoa, the world's coming to an end. I'm out. And it's so counterintuitive for people to say, no, this is where you have to kind of have the courage to understand the market, to step up, to put your capital to work. That is where you're going to experience the best ROI. And to your point, Simeon, is that you have to also have a timeline that's realistic. I would say 3 years bare minimum. And you got to look 5, 7, even 10 years down the road, depending on the strategy you're using, of course. But that's really the key to it. And now is the time. This is like when stuff will start to show up on sale. Not everything's a deal, but there's lots of deals out there. What's your thoughts?
There is hundreds of deals out there right now, identifying themselves, like they literally pop out screaming, I'm a deal, because they're deals, meaning the seller is distressed, the property may need something immediately, nobody can do it, somebody can close, somebody can do this. There's deals everywhere. Going back to some of the reasoning, and I think it's education that leads to smart investors, which is the Real Estate Investment Network, the REC. This is what we do. This is how we do it. So it's what I want people to understand is when I say 3 years, I believe it's going to be 10%. I didn't say 90%. That's a double-digit number as well. I said 10%. 3% a year, or probably 1% a year annual growth through the recession combined in Canada. I don't think there's going to be any more falling. I don't. I think probably March, we're going to see the bottom of it. And I do anticipate to see some growth as we're stabilizing. Banks are already cutting back the fixed to 4.95, 4.85. We've seen these numbers before. 07, 08, 09. That's where we were. My mortgage that I got in 2010 on my primary was 5.25. I thought I robbed the bank. So as we normalize, there's that. But there's also one major key. Employment, you had mentioned earlier, Patrick. We can't fill enough, especially in the skilled trades. So construction cost is going to probably be up by 25% construction cost. So the margin has to be protected. If that's the case, prices unfortunately, are also hedging and getting protected. So the price integrity of any given real estate market is being protected by its replacement cost. Like an underlying insurance policy. It's not something you can I wouldn't hang my hat on it, but it's another contributing factor to why prices are not collapsing the way people thought they would.
It's such a good point, Simeon, because, that's part of it. There isn't an answer that's connecting the dots to really look at it from, a kind of a holistic point of view, so that you're not just buying into the emotion. You're looking at data, you're connecting the dots, you're looking at things like what you just pointed. You've got, what is replacement cost going to be as, if prices continue to rise? We have that we have to deal with. Now, I'm wondering, Simeon, when you look at and hear about, we look at 5-year bonds and interest rates overall, there's lots of conversation being had out there right now by some experts in the lending industry, that they're seeing in the near future, a 4% fixed rate, 5-year term do you have a view of it? I mean, we're all just guessing because, after the fiasco of Bank of Canada, I think we would all be crazy to try and bet anything on anything around interest rates. What's your thoughts? So how do you see interest rates in the near term, let's say fixed?
As I mentioned a second ago, I've already been offered for my clients. They're getting back in with 4.8 for a fixed 5 years. So there is some light shining through the darkness already.
Yeah.
What I do think is going to happen. So my prediction and my hope, I should be careful how I frame this because I don't believe in it in my heart, but I think is the solution the market needs. So let me make this clear. Just like when a consumer, any of us, walk into a car dealership and say, no, and we don't ask how much the car is, but we ask how much the payment is.
Yeah.
That's what's happened in the rest of life. That's that millennial difference.
Yeah.
I know I'm not going to own the car. I don't actually want to own the car. I don't care about the car. I just want to know what it costs me to carry it.
Mm-hmm.
So in my heart, I'm the son of 2 Greek immigrants. I don't like it. I don't like that. I want to know what I own or what I need to own or what I need to have in my mind. Like, am I just making somebody else rich? I need to know what's happening here. So I ask more questions.
Yeah.
However, I do think that this country is going to approve a 40-year amortization before we see interest rates come down into the 3 territory.
Yeah, I just talked to a broker last week, Simeon, and I'm sure you did too, that there's a couple of B lenders out there, at least one that he shared with me that is offering a 40-year am. So, it's already happening. And I think that's the only way they're going to do it.
So if that were to happen at the highest level, at the big 5, the big 6,
yeah.
If that were to happen, we're going to see a tidal wave of sheep re-enter the market.
Yeah.
And get ready for another yet trying time where realtors are going to be just reeling them in.
Yeah.
So we are so fortunate to be in the RAIN network right now. Take this advice. People take this advice.
There's something, there's something here that we talk about, you said it. This country is, driven by payments. But I think what we have to consider, and we can say this about North America, primarily the US and Canada, of course, is that we are over the years, because all of our production has gone offshore over the years. Now, at some point, we got to try and bring that back. Technology, I don't know how we're going to afford to do it, but that's a different conversation. We've been a debt-driven economy. And debt-driven because money was so inexpensive, and it was able to, the joke about using your home as an ATM. I mean, how much has that been going on over the years? So there is that underlying concern economically that number one, real estate was a big part of the economy, that's for sure. But just overall, we're a debt-driven society, we're a debt-driven economy. So as interest rates rise, or if they continue to rise, it's not just about real estate. You're actually slowing down the whole economy, which is part of their plan. Consumer confidence, by the way, because I follow that number quite closely, is as low or lower than it was during the 2008 great financial crisis, by the way. And consumer confidence, lack thereof, people keep their hands in their pockets. They're not spending anymore. As a matter of fact, they're freaking out how they're going to make their line of credit payment that they use to renovate their house or buy a piece of investment real estate or buy a boat, whatever they did with it, right? So these are kind of some things that people are operating on top of going forward, Simeon. So do you take that into consideration when you're having conversations with your clients, I'm assuming? Are these the kind of conversations you sometimes have with them?
These are the only conversations that I'm having with them. So we pride ourselves on building our business using what we call as a REAP, a real estate analysis and a real estate action plan is what it actually stands for, REAP. Yeah. And during the REAP, it's a KYC for real estate. So I need to know how many kids you have. Are they healthy? Are you caring for an elder? Who are you? Everything about you, because I cannot guide you and give you risk advice if I don't know what it is you're risking.
Mm-hmm.
Who are you putting in jeopardy here? Is it just you and your cat? Or do we have other people that we need to worry about that depend on you? Because
Yeah.
if I tell you to go with this risk assessment versus this risk assessment, one you can get hurt in. You can double your money going to speculation,
Yeah.
or you can stay over here and take your 4 to 6% a year forever.
Mm-hmm.
Or go over here where it's a balanced mix, or all those things. So like, for example, today, because you had asked me to prepare, what can somebody invest in today in any of our markets where they can ride out the next 2 to 5 years? And we always go back to, there's always pre-construction. Great. Let's find a great developer. Or there's one of the biggest ones that we've talked about for 20, 30 years that, again, the government had the balls to dabble into lease to own.
Yes.
So if we're going to have the government come into the party, let's talk about lease to own.
Well, it's interesting. We all often say, and I know that you're on that same page, is that there's no bad time to invest in real estate. There's just the wrong tactics or the wrong strategy within that current economic real estate time. And so, back to lease to own or rent to own, that is a strategy that really can be put to work in this kind of an environment. And it's not difficult to learn. And it's really, if you're guided by somebody like you or somebody on your team that understands that whole lease to own concept and what that allows people to do in terms of putting their money to work, that's the kind of strategy we want to take on and use in these kind of economic times.
Yeah. So for anyone out there, let's say you have, whether it's 100, 200K, whatever the case, you're looking to get into a piece of real estate. By deploying this strategy, up to February of this year, lease to own was the ugly sister because the market was going up 10, 12, 15, 20% a year. And people knew it.
Yeah.
As long as money at the bank is free, you're going to see this kind of growth.
Yeah.
But the minute the money has now went up 7 times in 6 months, lease to own is going to be not your best friend. There's going to be a mad rush to do these deals. There's not going to be enough tenant owners per se. So I do want to cover all this off for all those who know lease to own. It might be a little bit of a refresher. And if you can give me kind of the mic for 10 minutes to just take them through the basics, the high level of the strategy.
Dude, let's do it. That's why we're here. That's why I got you on the show, buddy.
So Christina was kind enough to prepare this for me. I just gave her my last case study. I told her to just pull out some fact that I can just speak to the Real Estate Investment Network community. So investing to win through a recession. I've used this title before, because the only presentations I'm doing right now are surrounding 3 to 5 year plays. So anybody looking to speculate in this market is not going to be represented by my office. So unless you're buying your own home or your house hacking, meaning renting half of it, living in half of it, don't come to me looking for a 1 year exit and holding me accountable to what happens to you. It just won't happen. So we need the fundamentals in place, and we need at least a regular real estate clock on it, which is 3 to 5 years at the very least. So what is lease to own? Lease to own is by far the most traditionally lucrative strategy in real estate. It is where an investor, in this case, you, any one of you, are going to be purchasing a property that somebody else wants. Mr. Patrick Francey is going to be our tenant owner today. So Patrick gives my office a call, says, I want to buy a house. Simeon, the broker, takes Patrick out. We look at a house. Within a couple of days, we find out that Patrick went through a divorce or bruised his credit, or all the different things that take somebody's credit score or resources down. But at the end of the day, Patrick says, Simeon, I have 5%. Can I get a mortgage like anyone else? No, Patrick, you can't, because your credit score is 592. It needs to be 700 for you to qualify at 5%. Okay, Simeon, what are my options? I'm going to say, Patrick, my good friend Susan, right here, has the money. And she's going to buy the house and put it in her name. Susan is any one real estate investment network person watching right now. You are Susan. So you are going to buy the house that Patrick will live in. As Patrick is going to live there, he's going to give Susan 5%. Here you go, Susan. This is my down payment to you. We bought the house today for $500,000. You, Susan, you investor, put down $100,000, took a $400,000 mortgage. Patrick gave you 5%. He gave you $25K down payment, which goes against your down payment, or you put it in your pocket and go to Vegas, do whatever you want to do.
Yeah.
But he put down $25,000, so he has skin in the game. Your mortgage payment, let's just call it $1,000 for fun. Your mortgage, his rental, Patrick's rent is going to be $1,500 because it's $1,000 for rent and $500 for contributing to his down payment.
Yes.
So he is saving money automatically every month, but that is your cash flow. It has nothing to do with what the purpose of it is. You're bringing in $1,500 and you're $500 in the black every single month is a result of the deal structure. You also agreed upon, because you're doing this for him, you Susan, you investor, are going to take a fixed exit. Patrick is going to go on a plan to fix his credit. Patrick is saving money for his down payment as every month goes along. But in 3 years from now, or in 4 years from now, or in 5 years from now, depending on what term you negotiate, what you are looking for, Patrick is going to buy this property at a fixed price. That fixed price might be 5% a year. That fixed price could be 6% a year. It could be a fixed number. Patrick buy this in 5 years for $650K. Come hell or high water.
Yeah.
That's a dangerous strategy to do, by the way, because you're pricing out the market, and your appraisal and his appraisal may not come, and it might be a bad deal in default. We'll get to the savviness of it later, or experience of it later. But tying the property to market might be wise to do in a rising tide. Going with a fixed kind of average approach. What's the 40-year average in the market that you're in? 4.2%. Use that. Don't be greedy. Be smart. Because you want your data, your appraisal, your banker, and ultimately Patrick to succeed. If we go up by 5% a year and we do a 4-year deal, if it was worth $500,000 today, next year is worth 5.25. The year after, not even compounding. We can compound if you want to. We don't have to. Let's just do the math easy. 550, 575, 600. Your 100,000 initial investment, your down payment in 4 years has doubled. While enjoying positive cash flow, while enjoying a tenant who is actually living in their own home, not destroying your home. That if anything were to happen to Patrick, from emergency to life to death to anything, the house is in your name.
Still your
if
house.
Patrick defaults, it is what it is. I'm so sorry. Take care. All is well. Re-rent it. Keep it. Sell it. Do whatever you want. But at the end of the day, you executed on a deal in a market where somebody wanted the property. They gave you cash in hand to come in. Not
you can't step over that $25,000, that option payment. It's your money.
So it's just the lowest risk possible for a landlording play. You're helping another human being attain home ownership. You are profiting through the entire exercise in the 20 to 25% per annum territory. If we were to use the time value of money and do an IRR analysis, you're typically over 35%.
Yeah.
Because of the cash flow every month and all the different things. But to keep this simple, lease to own on a 90% basis will double your investment in 4 to 5 years.
You know what I've learned over the years as well, Simeon, and I'm sure you recognize it as well. So what we know is we've got a lot of immigration coming into Canada. So first off, there's a lot of tenant buyer possibilities just in the immigration. And one of the things in that immigration is that it takes people a couple of years to find out where they want to actually live culturally. These are things that, as investors, we have to consider. But, for those investors who are coming in and understand the culture, because let's say they are from India, let's say they are from Ukraine, where they start to understand their people because that's their culture, they know the nuances. So if they're investors, they can actually serve their cultural clients by investing and saying, that is who I want to support. And it's very, very effective. And and it doesn't matter what nationality, what culture, I use those as a couple of examples, but I've seen it many, many times. And, think about a little Italy. So if we had a bunch of immigrants again coming in from Italy, guess what? If you're Italian and you're an investor, guess what? You're going to be able to serve those clients, speak that language, understand that culture, know where they want to live. And it really is an effective investment strategy when your culture is your client.
And you're a housing provider.
Yes.
We're not scumlords in like, we're talking about using your capital for extreme profit with extreme community involvement.
Yes. Love it.
So it's one of the absolute best strategies in any day, but during a recession, buying yourself right now a property with a tenant who wants to be there and pay you and get all these things done the way I just described them earlier in a very colorful way for everybody to kind of feel the context of it is a fantastic strategy. It's going to take you 3 to 5 years out. And at that point, I think we're going to be in a completely different landscape, investment landscape, where you can exit this investment completely and go into something new or the same thing again.
And what I love about all of this is we wind these things down, Simeon, because you and I could talk about this stuff forever, is that REC Canada is also experts in that lease to own strategy. So it's not like you as the investor have to know and have the answers. As a matter of fact, you're working with an investor focused brokerage and group of people that understand these intimate details of how to be successful doing that. So thanks for sharing that strategy today, Simeon. I love it.
No problem. Lastly, I'm going to speak to some law that may be coming into play. And I think this is very, very, very relevant right now, because over the last 7 months, we've seen not a single thing change for the better from a supply side in Canadian real estate. So up to 7 months ago, all we spoke about was, supply. We're $2 million, 2 million homes short in Ontario alone of being able to service them. But then the interest rates came, wreaked havoc, and we think we solved the problem. We haven't solved anything. As a matter of fact, we're exasperating the problem, because if builders can't sell new construction, they're going to stop building, which half of them have. They've paused. Nobody exited their project. They just put them on hold.
Yeah.
So do we think they're going to come to market at a cheaper price than today? No.
No.
Do we not know that every year 400,000 people are coming in? Rents are going to keep skyrocketing. As rents skyrocket, they create a new benchmark for pricing. So prices are going up. So again, when I talk about factors, multiple factors as to why we believe something's going to go either this way or that way, we don't look at one thing. We look at 15 different things.
Yeah.
That all correlate. And as you said, well, what was it? Connect the dots. That's what we're doing. But there's one little asset class that can change the fortunes of millions of people here in the GTA, maybe elsewhere. But right now, Ontario is looking at the Better Homes Faster is the legislation, Faster Homes. I can't remember what it is. I was just speaking to Tim, the CEO of Maria, a few weeks ago on the podcast. Exclusionary zoning in Toronto is about to get eliminated. So for those who don't know what exclusionary zoning is, it's a NIMBY-founded principle to protect neighborhoods from density. That was done in the 50s. In the 50s, the government built veteran housing across East York, Scarborough, all these places, 800 to 1,200 square foot bungalows, 45-foot lots, like clockwork. Filled the cities. Everybody got back, veteran housing. What was veteran housing is now $1 million properties in the middle of the city, as per any other city. These properties, for you and me to develop them, we have to go through zoning, minor variance, a 2.5-year process that I have to carry. So I have to buy it for $800,000 or $1 million, carry it for 2 years before I can touch it. And only then will I build a mansion on it, because the flip exercise, I'll get a couple in and make $1 million profit on a flip. As opposed to, but that hurts the market as well, because now you need a $350K income earner to live there, which there's plenty here, but we're hurting affordability in the city of Toronto. To fix affordability, that cannot become a mansion, that needs to become a fourplex. If exclusionary zoning goes next month, I can tell you that every penny I have, I will be buying bungalows left and right. The closest to the subway, the better. But the city of Toronto, if they want to fix their affordability problem, they know what they need to do, and they will instantly create millions of doors organically, with the wealth staying with the families who have it today. Meaning, if I own an East York home, why the hell would I ever sell it? I'll go to my architect to get a nice fourplex, sixplex, eightplex. It's a 50-foot lot. You can put an eightplex on it, no problem. Take a loan from the bank, build it, brand new, beautiful, brand new housing, 200 meters from the subway. I get $3,500 a door. What does that mean? That means that instead of getting one tenant to pay you $8,000, and if anybody thinks those numbers are fake, give your head a shake. This is what's happening right now. But how many people can afford $8,000 a month? Not many. How many people can afford $3,500 a month? Way many more. Even though that's a high number for most of Canada to comprehend, here it's not. Here it's reality. So, but that is affordable housing in density where it matters. So if anybody in this audience is sitting on dry powder, meaning cash and capital, this is the time to be watching the news. This is the time to be coming to the next meeting of RAIN. This is the time to be watching like a hawk, because opportunities are a coming. And whoever has that capital is going to gain big.
Beautiful. Good time to reach out to REC Canada and your team. Simeon, we covered a lot of ground. Economy, real estate strategy, a little bit of politics, interest rates. Wow, we covered a lot of ground.
Our love for the Bank of Canada.
Oh, boy. Okay, well, listen, thank you for your time and always what you bring to the table. So appreciate it, pal.
I appreciate you, my friend, and happy holidays to absolutely everybody. Happy New Year if you're catching this in January. All the best. Health, wealth, and all of it. Lots of love.
Fantastic. Thanks, Simeon.
Cheers.